welcome to the Alternative Marketplace. Whether you're streaming or watching us on Business Day TV, DSTV channel 412, it's great to have you with us in this new hybrid world that we're inhabiting. And investments are no different. One needs hybrids or diversification during times of rising public market volatility, rising inflation and interest rates and geopolitical tensions. And that is certainly what Africa's largest alternative investment conference aims to offer you over the course of the next few hours around the world in response to first the global financial crisis and then the COVID pandemic. Central banks have provided extraordinary stimulus to the economy in recent years through low interest rates, asset purchases, and even the rarely used helicopter money via stimulus checks in the US and other jurisdictions. And it's boosted almost all asset prices and may have broken down some of the traditional correlations between bonds and equities. And investors have been finding it increasingly difficult to find assets that achieve their required return because all of this liquidity has pushed up asset prices, making it an expensive time to be investing. And with the pandemic and political uncertainties, the risks associated with those assets, most influenced by factors such as interest rate movements, are elevated at the moment. The market was concerned before the Omicron variant that the velocity of all of this money would accelerate to produce long-term inflation. And it's still a significant risk. Structural inflation could create a turning point in interest rates, and the geopolitical tensions that have caused a spike in commodity prices have served to amplify the fear over inflation. And this is where the rise of alternatives comes in. Alternatives can play a role in protecting investors' wealth amid such turbulence, but careful thought is required, particularly around portfolio construction and asset selection, as not all alternatives have the same characteristics. Leaving cryptocurrencies and other lesser-known strategies to one side for the moment, alternatives consist of hedge funds, non-investment grade debt, private credit, private equity, and real assets such as property and infrastructure. Now, to varying degrees, all of these asset classes provide some form of diversification to mainstream markets and global economic growth. Combining them can provide exposure to factors that are not found in traditional asset classes, as well as the much sought-after manager's skill. Now, one needs diversification during these times, especially. And we've got windows into the world of hedge funds, private markets, structured products, disruptive technology, PE and VC markets, as well as cryptocurrency and emerging markets and more, as we play host to some of the leading alternative investment fund managers on the African continent. Some housekeeping for our streamers. Please keep your questions coming through. And if you're watching the good old-fashioned way, whip out your smartphone and join the conversation. We'd love to hear from you. And you can ask questions in the chat box. And in addition, if you want to schedule a meeting, go onto the website. You can schedule a meeting with any of the presenters today, right here. Now, Sephira is an emerging markets dedicated investment boutique based in London. Sephira manages liquid strategies, marrying concentrated portfolios with a risk management approach tailored to EM's intricacies. And there are a lot of those at the moment, as we see with what's unfolding around Russia and Ukraine. Jason Mitra is the firm's CIO and has been managing risk in emerging markets for the better part of the last 26 odd years. Without giving too much of your age away there, Jason, over to you.
Hi, and thank you. My name is Jason Mitra. I'm the CIO and founder of Sephira. We're a London-based EM boutique. We manage liquid, long-only and long-short money for institutions and high net worth individuals. The firm has been in existence since 2017, although the team's been together for a decade. And we all have many, many years of experience navigating the volatility and challenges presented by the array of emerging markets that we focus on, from Latin America to Eastern Europe, Africa, and the Far East. Our USP is that we run a highly concentrated portfolio of stocks, typically 15 to 30 long investments and 25 to 40 shorts. Drawn from a fairly narrow universe of only 200 potential longs in our universe of stocks that we cover, and 150 or so potential shorts, drawn from a much wider universe of 10,000 plus potential stocks. And the key criteria for us that we focus on is liquidity. For us, external risk in emerging markets can often overwhelm the merits of a fantastic bottom-up stock picking thesis, and we need to be able to recalibrate and adjust the size and shape of our portfolio to adapt to the volatility that is a characteristic of emerging market investments. Our objective is to deliver equity-like returns over the cycle with lower levels of volatility, and our strategies have delivered that for the best part of a decade now. We have a team of 8, 6 members of the investment team. Within that investment team, 2 dedicated risk managers and quant, which gives you a sense of the attention we pay to risk management. And we feel that the process that we follow delivers an output which is quite different to that of our peers. This first slide that I'll show you here it shows the large gold dot is the performance of our long strategy versus the entire universe of global emerging market long funds peers taken from the eVestment database. And you'll see 2 things here. One is pleasingly the return profile is up there with the best in class towards the top end of the grid, but also that our beta to MSCI emerging markets is relatively low at around 0.55. So there is something in the makeup of our portfolio which gives us a lower beta to broader markets, but allows us still to deliver best in class returns over time. And part of the explanation for that is the quality and of the stocks that we invest in. So we have a degree of protection to returns from the quality of the investments that we choose. Another differentiated characteristic of our strategy is our low correlation to China, which obviously makes up over a third of emerging markets right now, and for much of the last 4 or 5 years has dominated returns, given the phenomenal momentum of Chinese internet strategies, which have obviously fallen out of favor somewhat over the last 6 months or so. And that speaks to the construction of our portfolio. We are absolutely benchmark agnostic, and regard the opportunity set of markets away from China as valid as that of the benchmark dominating country. And you'll see in a moment that a significant proportion of our allocation returns comes from off the beaten track geographies: Greece, Mexico, Peru, Egypt, Indonesia, the Philippines, and so forth. And it is natural that we would expect to find greater pricing inefficiencies in these geographies that are less well analysed by the investment banking community and garner less attention from either a domestic or international asset management community. In our long-short manifestation strategy, we have a pretty decent track record, of which we're proud of managing returns during moments of market distress. Since the strategy came into existence in 2017, the gold bars illustrate our fund's strategy's performance during the most severe market downturns that we've seen over those times. So a pretty good experience during moments of distress. We are fully invested ourselves as managers in these strategies, and our objective in long short is to protect capital during periods of distress. Another characteristic of our portfolios is valuation. We're not outright value investors, but we like to anchor the portfolio in a predictable and understandable valuation. The gold bar is the trailing PE of our portfolio versus the blue bar, that of the S&P, clearly quite expensive right now, and then that of MSCI emerging markets and China, which has recently derated. And I would say that at the moment there is a clear valuation opportunity for China emerging markets in our portfolio versus that of the developed world. And when one thinks about the policy set in front of us right now, the US and Europe at the end of an economic cycle, at the limits of monetary easing, or I would say are almost forced to raise interest rates to contain inflation, at the end of their fiscal tethers following COVID, we look at the emerging world at quite a different state. Across the world, emerging world, we've seen a fairly steady raising of interest rates over the last few quarters, which leaves us with quite a strong monetary buffer in many parts of the EM world, and a clear room for fiscal expansion, most notably actually in China right now. So quite different valuations and quite different periods of the cycle to confront the big geopolitical challenges that markets face right now. When we look at our portfolio construction, as I mentioned, our returns have been driven by quite off the beaten track geographies. The gold bars illustrate the returns of our long portfolios, the blue bars of our shorts, and you'll see that the greatest part of the return has come from the likes of Mexico, Greece, which is only 0.3% of the EM benchmark, India, Peru, and elsewhere, China, something of an also ran. And similarly, in terms of sector allocations, we have tended to focus on sectors that benefit from the natural tailwind of emerging markets, which is penetration and demographics, which would lead us to have a structurally higher allocation to consumer and financials, which in the emerging world are often interlinked with the expansion of consumption, credit cards, auto finance, mortgages, and so forth. Less exposure over time to more cyclical, more volatile sectors such as industrials and materials. In terms of exposures, you'll see our current allocations are somewhat skewed for the first time, actually, given the valuation opportunity towards China, and that would be, I would guess, in a sort of contrarian fashion to many global managers' opinions of that geography. Our view is that top down, we are at the beginning of a quite substantial fiscal expansion, and with plenty of room for monetary easing as well. Valuations are absolute rock bottom. The Hang Seng stock index, for example, is trading at a 10% discount to the 2020 COVID low. So seriously distressed valuations there at a time when we're starting to see a stabilization and actually recovery in economic activity, almost the exact opposite of what we're seeing in the developed world West. So for us, for the first time in 4 years, a significant allocation towards China, contrarian, you might say. We also have exposure right now to Egypt, particularly through fertilizers, which one might understand would be an attractive proposition given the current embargo on exports of potash and so forth from Russia, and then to India, the Philippines, Taiwan, geographies that were late to unlock from COVID and have a runway of consumption and economic expansion as the COVID experience phase a year or so later than we saw in other parts of the developed world. That brings me to the end. So if there's any questions, I'd be happy to take them.
Well, so much to take in there, Jason. I think very interesting to see how you are positioning in China, considering how much attention China has received here in South Africa through Naspers and Process and their office holding in Tencent, and how much that has sold off and derated over the last while. Emerging markets in general, though, are a notoriously volatile space. And we see with what's going on geopolitically in the world at the moment, very difficult to navigate these waters. What's different in the way that Sephira manages this risk?
So we dedicate a third of our investment team to quantitative risk and risk management. And we have a procedure which we've developed over the last decade that effectively forces us to handicap all of our potential investments according to an array of external risks. Country risk is one of them. The sector in which a business resides is another. For example, a mining company will be intrinsically more risky and volatile than a staple business, and also the factor exposures that a stock might bring. So the interest rate sensitivity of a company, the FX sensitivity of a company, or the sensitivity to commodity prices, wheat or grain, all these external factors we input into a risk management model and effectively handicap away from businesses that are significantly exposed to external or unpredictable risks. What that leads us to is a portfolio which is highly idiosyncratic and really stands up on and is scaled to the best near-term idiosyncratic return profile that stocks can give us, as opposed to taking significant external risk exposure, which is obviously unpredictable and variable, as recent experience in Eastern Europe has told us.
Yeah, and I'm glad you mentioned that, because so often I think the misconception about hedge funds is they're inherently risky. They certainly are. I mean, if you think of long-term capital management, there have been some risks, some big blow-ups in the past, but the good hedge funds, the ones that I've certainly come to know and respect, have always been acutely sensitive and aware of how they manage that risk, and I think this is a great example. Jason Mitra, CIO of Sephira, an emerging markets dedicated investment boutique based in London, as we heard from some of the London traffic in the background there. Really a great way to kick us off here